Today, I want to look at combining elements of both value and growth, combining them together to create a growth at a reasonable price search on Schwab.com. First, let's look at some disclosures, though, to get started. Okay, information here is for general information purposes only and should not be considered an individualized recommendation. Paper money software application also for educational purposes only. Investing in stocks does involve risk, including loss of principal, and past performance is no guarantee of future results. Now, let's go ahead and pull up the stock screener on Schwab.com, and I'm just under the research tab at the top here. Now, let's go ahead and click on this to begin building that growth at a reasonable price search and explaining it along the way. Okay, so over here, I want to start off with the basics, and I want to look, let's just say, with companies that are within the S&P 500. It's a great way to select that over here. We can look at exchanges. Actually, I'll choose the index right below it. We can look at entire exchanges, other categories as we search out baskets to search through. But in this case, we'll choose the S&P 500. Okay, so with that, let's start off with some criteria. We've got, as it states right there, 503 total companies as it stands right now. Now let's go down here, and I wanted to highlight growth first. Now, growth at a reasonable price. Now, one thing we can look at is past growth in earnings, for example, and even future growth in earnings or expected growth in earnings. So with that, let's go ahead and take a look at company performance right here. Now, we do have earnings history. We have a 3-year earnings history listed right there over the last 3 years. We can set specific criteria in here to define growth over that time frame. And at a bare minimum, a lot of investors might want to see over the last 3 years something along the order, if they're looking for growth specifically, it's oftentimes defined as like 15% or higher per year. Now that can vary, but that is just one example. You see over there that knocked our total matches down to 128. Companies in the S&P 500 that have been able to grow at least 15% or higher over the last 3 years. Okay. Now, in addition to this, what I can do is go over here and look at the expected EPS growth. Now, this is going to be listed into the current fiscal year or the next fiscal year. A lot of times traders will use the current fiscal year if we're not all the way through, let's say mid-year. They might start off with this. I'm going to go ahead and just go out a little bit further and go the next fiscal year. And it's comparing the next fiscal year, the current fiscal year to the next fiscal year's growth. Okay. So with this, what I want to do is also list at least that standard growth criteria right here. So let's go ahead and just plug that in. Oh, 15% right there. You can see it adjusted again. So that really narrowed us down quite a bit. Estimated EPS growth at 15% into the next year. Wow. Okay, now down to 38 companies. So this is combining two elements. We've got historical growth in the past, okay, where we are right now in the present, and then we've got expected growth going forward. Now, both of these, we're looking at 15% or higher. Now, we might find higher earnings in different baskets of stocks that might be have historical growth rates. Let's say, for example, technology that might exceed 15%. But that's the list of where we're at right now. Let me go ahead and just run this just to show you that 38. You might recognize many of these companies, and by the way, many of them are in the technology. There's healthcare technologies I'm seeing, and others listed here as well. Some of the pharmaceutical, maybe biotech companies that are also coming into play here. But the question is we've got these numbers over here. That's great, but traders do like growth, but one of the key elements is buying it at a price that makes sense as well, because we could buy these substantially higher, but then how much of a return would we potentially have on the stock? And a lot of times, if the stock is priced quite high, it may be referred to as being priced to perfection. In other words, if that growth slows down just a little bit, perhaps share prices might drop substantially. So some investors might want to try to buy it low or at a reasonable price. To do that, we can take a look at the valuation metrics and just see where, for example, since we are looking at earnings here, where exactly does our PE stand, or price to earnings ratio? Okay, now what I'm going to do, I'm not going to select a particular number. I'm just going to overlay this and just let us take a look and see where we're at over here in terms of earnings. Okay, or PE ratio, price to earnings ratio, as it stands right now. I'm going to click on it one time and just kind of highlight areas where we might be. Let's say, for example, some traders would look at technology companies. They might look oftentimes below 35 is just a benchmark that some investors might use. Some would look below 30. Others are a little bit more stringent and they're looking for price to earnings ratios, what they're willing to pay for the earnings of the company relative to price at 25 or lower. Now, these are some of the companies that are at 25 and lower right here. I'll just draw a quick line over here just to kind of highlight the difference. Yeah, we'll just leave this one in here. It's a little bit above 25, but in that range. So 25.42 for Expedia right here. Now, those are the baskets of stocks right here that you're seeing. Now, one interesting thing to kind of consider here is that we're looking at price to earnings, and then we're also looking at the growth rates, past and future growth rates. And a lot of times if, like say, for example, traders are looking, I'm just going to use this as an example here, but if you're looking over here at this company, SMCI, for example, growth rate historically 46%, 34%. Well, comparatively speaking, you can see kind of where the value might be. Where are we at if we're factoring in these growth rates relative to the PE ratio? PE ratio, those earnings are being actually valued at 20, whereas the earnings themselves or the earnings growth rates are higher. That right there would be considered, in the minds of many investors, growth. This is the acronym for it, just a GARP trade, growth at a reasonable price. Okay. Growth at a reasonable price right there. Now you can do the same thing as we go up. You've got T-Mobile and others in here, but that is an effective way, a quick way to find this right off of schwab.com in the stock scanner. It's a great tool to have. Now, one thing in addition that I wanted to highlight, there is a ratio out there. I did a prior class on it, but I just wanted to highlight it for now as well, and that is the PEG ratio. The PEG ratio does combine an element here. It doesn't look at historical rates as much as it does look at future rates. So you've got the PE ratio, which is part of the PEG, and then you've got a growth rate. This is the projected growth rate out to the next year that we're actually looking at. There is actually a ratio that does that, and that ratio is right down there. One thing, though, traders do like to do when they're looking at that PEG ratio is they might have a reference point. What's the historical earnings been? What have the historical revenues been? Does it have a history of being able to actually generate earnings growth? Does it have that potential? Everything here is above 15%. You can see many of these are clearly above that level, but we're looking at least 15% plus, okay, is what we were talking about here, or higher, 15+%. Okay, so that is one thing that can be run. I'm going to go ahead and run that search right now to give you a couple of these different search criteria that can be used. I'm going to keep this 3-year on though, just as a reference point. But basically, that ratio is including the PE ratio and the growth rate. Let's do it right now. Now, a quick note on this, if we are looking at less than 1, I just want to highlight this. If it is less than 1, that does by definition tell us that PE ratio, the PE ratio, okay, as part of the PEG, and that is again our projected growth down here, it is lower and this is higher. That is how we get less than 1 on the PEG ratio, this being the PEG ratio over here. Okay, so in other words, the projected earnings growth rate is above what prices are being valued at right now in relationship to earnings. And you can see that right over here with these companies. We only have actually 12 that meet this criteria that also meet the criteria of growth over the past 3 years. And that is another whole basket of companies. You've even got like a financial company down here as well, and some others. I believe this is a reinsurance company too, in the insurance line, but reinsurance. And interesting basket. But these can be areas that investors will look for to really kind of dive in and highlight areas of interest where they're finding growth prospects, but also at a reasonable price. Now, folks, I just wanted to highlight too, love to have you follow us here on our Trader Talks channel. If you've not joined us before, just Trader Talks on YouTube. Little subscribe section over here where we have playlists, etc. over here as well. Please give this video a like if you enjoyed it as well. And please feel free to follow me on X. You can follow me at Mike Fairborn CS.